welcome to the Business Standard Morning Show. I'm Kanishka Gupta. Let's have a look at the stories for the day. When 2022 began, it looked as if India had successfully navigated the immediate challenges posed by COVID-19. But its economy, which had appeared poised to start the healing process, was hit by another shock: Russia's invasion of Ukraine in February. It resulted in soaring commodity prices. However, India weathered that storm too. And as the year comes to a close, the country has emerged as a bright spot in an otherwise dark horizon. But does that mean that all was well on the economic front in 2022? Were there any challenges that emerged that are yet to be resolved? And how is the economy likely to perform in 2023? Bhaswar Kumar brings you the answers.
As 2022 comes to a close, India's marketplaces and airports are crowded, even though fears have arisen over the explosion of COVID cases in China and the possible fallout here. Festivals have been celebrated with pomp. Major sectors have recovered to pre-pandemic levels. It has been a year of recovery, in spite of the continuing geopolitical challenges that emerged at its start. In early December, the World Bank raised its gross domestic product growth forecast for India for the current financial year to 6.9% from 6.5%. At the time, it was the first upgrade of India's growth forecast by any multilateral agency or bank in FY23, and it came after a spate of earlier downgrades. In fact, the World Bank too had cut India's FY23 GDP forecast to 6.5% from 7.5% in October. According to the World Bank, India's economy has been remarkably resilient to the deteriorating external environment, and its strong macroeconomic fundamentals have placed it in good stead compared to other emerging market economies. At the latest Reserve Bank of India Monetary Policy Committee meeting this month, the GDP growth forecast for the current financial year saw a mild reduction to 6.8% from the earlier 7%. In its latest report, ratings agency Fitch retained its FY23 GDP forecast for India at 7%. Despite the movement in growth forecasts, India has emerged as a source of global economic stability and is still the fastest growing large economy. However, this does not mean that serious economic challenges did not emerge in 2022. Persistently high inflation was perhaps the biggest one. However, the retail inflation rate unexpectedly deaccelerated to an 11-month low in November. Data released by the National Statistical Office showed that the consumer price index-based inflation rate eased below the RBI's upper tolerance limit of 6% to 5.88% in November. The reason was a sharp moderation in food prices. It stood at 6.77% in October 2022 and 4.91% in November last year. Average inflation has remained above 6% for the past 3 consecutive quarters, constituting a failure on the RBI's part to meet its inflation mandate. On a worrisome note, core inflation, which excludes volatile food and fuel prices, inched up to 6.3% in November from 6.2% in October. In his latest monetary policy statement, RBI Governor Shaktikanta Das had expressed concern over sticky and elevated core inflation, adding that the battle against inflation was not over. There were other headwinds too. The rapid pace of monetary policy tightening in advanced economies resulted in large portfolio outflows and depreciation of the Indian rupee. Meanwhile, high global commodity prices led to a widening of the current account deficit. Against this backdrop, we spoke to economists to find out their assessment of India's economic performance in 2022.
The positive side has been the revival of contact-intensive services, which have been supporting the economy. The investment cycle also, I think there is no decisive pickup there, but the government investments did support, and in some areas, private investment also started looking up. We have recovered to the pre-pandemic levels. I think that is true, but I think we are definite. But despite that, I think we are still below the level where we would have been without the pandemic. So there is a permanent loss. The economy has been pushed back, and that is very difficult to recover. For that, it requires much faster GDP growth rate.
I'm not surprised that in FY22 we've had a recovery, because we were starting from a low base, and that low base has helped us to sustain growth to whatever it might turn out to be in the region of 6.5% to 7% in FY23. So to that extent, in overall terms, we've done okay. But we've done okay only on account of two engines of growth, while the other two engines of growth are not firing. The two engines of growth which were doing okay and which are already sputtering are exports, and the other one was government expenditure. And there are constraints on both.
If 2022 was a year of unforeseen challenges, the headwinds India is likely to face in 2023 have already been discussed across multiple forums at some length. In a panel discussion at the recent Business Standard BFSI Insight Summit, leading economists said that with a third of the global economy expected to slip into recession in calendar year 2023, the impact would be strongly felt on India's exports and trade economy. The panel comprised former Reserve Bank of India Executive Director and former Monetary Policy Committee member Mridul Sagar, State Bank of India Chief Economic Advisor Soumya Kanti Ghosh, Citibank India Chief Economist Samiran Chakrabarti, ICRA Chief Economist Aditi Nair, and IndusInd Bank Chief Economist Gaurav Kapoor. However, in a view that was echoed by his co-panelist, Sagar said that even if India's growth were to slow down, it could still grow around 6% next year. The World Bank has also warned that India will not be insulated from spillovers from the US, Europe, and China. As a result, its India GDP growth forecast for FY24 has been cut to 6.6% from the earlier 7%. At its latest meeting, the RBI MPC retained its inflation forecast at 5% for the first quarter of the next financial year and made a projection of 5.4% for the second. For the first quarter of the next financial year, GDP growth was projected at 7.1% against the MPC's earlier projection of 7.2%. GDP growth in the second quarter was projected at 5.9%. Against this backdrop, what do leading economists have to say about how the Indian economy will perform in the coming calendar and financial year? And what are their expectations from the budget?
I think our forecast for 23-24 is GDP at 6%. The year 23-24 will be the test of resilience of the domestic economy. And here I think the key drivers, according to me, will be one, the government support to the investment cycle. So what I mean by that is we expect the budget to be focused on infrastructure investment. So that will be one engine of support. The second will be the private investment has started ticking, but in the uncertain environment, you cannot expect a full revival. Here I see the government playing a role in providing support via increased support to the schemes like PLI, which will trigger the private sector to invest in an uncertain environment, so to say. So I think that's the limited part the budget can play.
The budget has to make sure that it comes up with a package which enables job growth to happen, because if job growth happens, then wages will rise. And if wages rise and job growth both happen together in the non-farm sector, workers are pulled out of agriculture, private final consumption expenditure, including in rural areas, will rise. And when that begins to rise, private investment should kick in. So my fear is that we shouldn't expect too much out in either FY23 in terms of growth, much better than 6.5%, and perhaps even remaining there if that in FY24.
2022 has taught Indian policymakers a crucial lesson. Amid a dynamic global environment, headwinds can emerge from unforeseen quarters. While some of 2023's economic challenges have already been identified, there's no certainty that more won't emerge. The coming year could very well test India's economic resilience even further.
A well-oiled public transport system is the key to any country's economic growth. And no doubt, the Delhi Metro has contributed a lot to the national capital's economy and by extension to that of the whole country. In the last 2 decades, it changed the transport landscape of the country's most populous city. Last week, Delhi Metro celebrated 20th anniversary. Our next report by Tariq Ahmed traces this transformative journey.
Population in the national capital Delhi has been increasing rapidly. In fact, it has been doubling every 20 years. In 1961, it was 2.6 million and it rose to 6.2 million in 1981. And in 2001, it reached 13.7 million. Somewhere in 2008, Delhi overtook Mumbai as the most populous metropolis of the country. By the year 2000, Delhi's public transport was bursting at the seams. Rowdy Blue Line buses were leaving a trail of pollution and injured commuters too. Increased private vehicles ownership added to Delhi's traffic woes. Between 1981 and 2001, the number of motor vehicles in the city grew more than sixfold from 540,000 to 3.8 million. And amid this bleak transport landscape, the government decided to introduce a mass rapid transit system to Delhi. After about 3 decades of planning, Delhi Metro was finally sanctioned in 1998. 64% of the project costs were provided by the state-sponsored Japanese Bank of International Corporation. 28% of the project costs was financed through equal equity contributions provided by the central and Delhi state governments. In the phase 1 of the metro construction, 64.75 kilometers of rail network was built and it had 59 stations in 3 routes. These were the initial parts of the red, yellow and blue lines. And the trains started running in these routes from 25th December of 2002. In the second phase, a total 123.3 kilometers of rail network was built and there were 86 stations across 6 lines. Green, violet and orange lines were the new routes added in the second phase, along with extending the pre-existing routes. Phase 3 focused more on radial lines to improve the connectivity and avoid congestions. Also, Phase 3 brought routes connecting to Gurgaon, Noida and Ghaziabad. Soon after the launch of the first metro line, E. Sridharan, who is also known as the Metro Man, said that it will be much more than a cheap and safer means of transport. It will reduce congestion on roads, making movement easier. It will also reduce atmospheric pollution to a great level, making the environment healthy. The metro will totally transform our social culture, giving us a sense of discipline, cleanliness, and enhanced multifold development of this cosmopolitan city. Metro not just brought the killer blue line buses to a halt, it also brought down the pollution levels. Compared with 1997, the concentration of carbon monoxide in 2002 fell by 32%. Sulfur dioxide levels dropped by 39%, and particulate matter that causes respiratory problems has been mitigated.
It has become the primary mode of choice for people to travel in Delhi, and hence a significant shift has happened from the private vehicle travel into the one which is in terms of the Delhi metro part of it. The similar decarbonization impact would have happened even in terms of from movement from buses even into the Delhi metro part of it. And if you have a long haul travel, this has been quite significant. While a number can't be put in, what I do understand from reports is that close to 20 crores is in rupees terms is what Delhi Metro were able to get in terms of the greenhouse gas emission control that they were able to prove, and then they were able to get that kind of a carbon credit in as the monetization that they were able to demonstrate. So that goes to show a significant amount of carbon reduction has happened for Delhi Metro.
Even though Delhi Metro has improved the transit system in the city, it could have been better in so many other ways. According to Rutul Joshi, Senior Associate Professor at CEPT University, Delhi should be coming up with a more integrated transit system that will bring the metro, bus, and all the other public transport systems in one umbrella to make the most out of it.
So there is information integration, there is ticketing integration, there is fare integration, there is physical integration, and there is institutional integration. There are 5 kind of integration which you start planning for. ओके सो अभी क्या हुआ है कि इंडिया में हमको प्रोजेक्ट बनाना आ गया है, सिस्टम बनाना नहीं आया है. You know, that is what I'm hinting at. I mean, if you tell me that yes, Delhi Metro did a great thing, they did remarkable amount of urban infrastructure project, which after independence we have not seen. Okay, I don't think that, and I told you, it's one of the largest urban infrastructure project this country has seen. I don't think that any other place we have seen this. Okay, and of course the amount of money that central government put in and the amount of power which was given to DMRC and all of that, right? But imagine if we had planned at that time transport for Delhi and not metro for Delhi, we would be even better. And ये जो सारा problem हो रहा है ना आजकल कि buses का ये problem है, last mile connectivity का problem है, you know, all of those things we could have sorted out at that point in time. So I'm saying, while I'm appreciating what DMRC has achieved, I'm also saying that these are the lessons that we need to learn.
Delhi Metro provided inspiration and lessons for the upcoming metro projects in the other cities of India. 15 cities have operational metros now, and scores of more cities are now planning to roll out this advanced public transport system. It will indeed go a long way in fulfilling India's commitment to turn net zero by 2070, while easing congestion in the growing urban landscape at the same time.
Moving on to the financial markets. Global headwinds forced India's primary market activity to take a backseat, with new listings falling by around 50% from 2021. However, on average, IPO returns in 2022 outperformed those of the Sensex index. Against this backdrop, will retail IPO investors remain energetic in 2023? Deepak Kargonkar and Harshita Singh answer in our next report.
2022 was a dismal year for the IPO market with fewer participation from companies. Some big names like Farmeezy, Boat and Snapdeal even dropped their plans to go public. Around 32 companies have raised Rs 55,000 crores so far this year via IPOs. It is less than half of the total fundraise in 2021. Though the IPO pipeline for 2023 remains robust, with as many as 55 companies having received market regulator SEBI's nod to raise 84,000 crore rupees. Some of the biggest offers are from Aadhar Housing Finance, TVS Supply Chain and McLeod's Pharmaceuticals, ranging between 5,000 and 7,300 crore rupees. Against this backdrop, analysts expect 2023 to be a better year for the IPO market, which will likely see sustained participation from investors.
I think 2023 is expected to remain, I think, a promising year. And many companies which are likely to hit the market are the ones which are having relatively good business to talk about and good business to get listed about. retail investors definitely, I think, would remain excited about possibilities of good companies getting listed. But as I have said, that I think for retail investors to stay invested long term into the company, I think the pricing point should be comfortably leaving some amount of headroom for the rally and rise. And B, I think most of the IPO attracts most trader investors or flippers, as we call it in market language. Those flippers, in order to keep them slightly away, I think discourage them by way of, I think, putting in the taxation impact on them. So those who flip the IPO may probably, I think, get to pay higher taxes. It's something which can be brought in.
Most IPOs in 2022 have managed to deliver decent returns to investors despite the overall volatility. About 71% of the 32 new listed stocks that are currently above their issue prices. Of these, Adani Wilmar, Venus Pipes, Hariom Pipe and Veranda are the top multi-baggers that have delivered 100 to 117% returns in 2022 over their issue prices. On the other hand, the top wealth destroyers this year included India's largest listing of the state-run insurer LIC, which slumped 31% against its issue price, followed by Delivery and Inox Green Energy that have shed 34 and 37% against their respective offer prices. Besides, the new age startups that have not been able to arrest the market price erosion post their listing succumbed to even sharper sell-off this year amid rising rates and anchor investor exits. Analysts thus advise investors to carefully evaluate a company's investment proposition going ahead.
And those companies which came into the market gave also an exit to the key investors who had invested into those companies in earlier years. As was expected, I think these companies which were non-profit-making companies, they created the excitement into the market before listing. And post-listing, I think that excitement fizzled out, and as a result of which the investors started asking for profit performance as against the euphoria. That is the cause of, I think, the fall, because I think these companies haven't been making profit. The models of the business are not exactly, I think, in direction of making profits. They are probably too many years away from making profits. So the key learning for the investor is that as a consumer, some brands may work better. Not necessarily those brands will always work for you as an investor. So be careful about putting money where you find that the investment proposition is weak vis-a-vis the consumer proposition.
That said, the street will track the IPO of SA Polymar later this week along with the industrial output data.
Meanwhile, energy trading platform Indian Energy Exchange or IEX recently announced that it was the first carbon neutral power exchange in the country. To cut down on carbon footprints, IEX used market-based tradable instruments. What does that mean? How does a company become carbon neutral? Let's find the answers and look at how carbon trade works.
It was not until the 1990s that climate change was proven to be a real thing. The world looked the other way and took a lot of time to realize the effects of human-induced changes on Earth. The first effort to bring nations together to act on climate change was the Rio Earth Summit of 1992, where the United Nations Framework Convention on Climate Change, UNFCCC, was introduced, and it came into force in 1994. But measures adopted at the Rio Summit proved to be ineffective. This called for a new framework, which was introduced at the Kyoto Summit of 1997, known as the Kyoto Protocol. The Kyoto Protocol was able to bring in more countries to a system that legally bind the parties involved to reduce greenhouse gas emissions. The Kyoto Protocol urged industrialized countries of the world to reduce their greenhouse emissions by 5% from the emission levels of 1990. This puts a cap on how much carbon a country can emit. For saving each ton of CO2 emission than what is permitted by a company, it will receive a Certified Emission Reduction, CER for short. A CER is a certificate issued by the United Nations to member countries for preventing 1 ton of carbon dioxide emissions. It acts as a currency and promotes emission trading in several countries around the world. There are 2 other ways a company can earn CERs. The company can fund the initiative that will bring down greenhouse gas emissions in developing countries that are not under the strict measures of the Kyoto Protocol. This project-based market mechanism created by Kyoto Protocol is called Clean Development Mechanisms or CDM. An example is funding renewable energy production in developing countries. The other way to get more CER credits is following the same in developed countries, which is called joint implementation. To become a carbon-neutral power exchange, IEX has voluntarily cancelled the Certified Emissions Reductions or CERs from clean projects registered under the Clean Development Mechanism or CDM of the United Nations Framework Convention on Climate Change and used market-based tradable instruments. It means the power exchange has bought CERs earned through clean development mechanisms and given up the CERs forever. So no other company or country can ever buy these voluntarily cancelled CERs to have the right to emit more greenhouse gases.
I will achieve, I will fly high. IEX,
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
After the pandemic-led uncertainty, discoms are now preferring to buy power from IEX, which is fueling the growth of the exchange. That is all for today. For more news, views and insights, please log on to business-standard.com.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.